Hi, I'm Peter Rose, founder of Longwood Currency Trading. Swinging for the fence. Why do you do it? When do you do it? And how do you do it? I've had some emails, one in particular, asking me about this. The other day, I made, I think I said $4,400 or something, but it took me 7 days. I did a carry trade on that. And so I just discussed how the per day profits from that was actually less than what I had been sort of making on a daily trade basis prior to that. And so the question was, well, the validity again of the carry trades, even though they're a lot of money, $4,400 from a daily percentage trade wise, it's probably less. And then yesterday, we're closing out. We're now in early September, so the last trading day of August, a couple of days ago from when I'm going to put this video up, I made $4,100, but I made that on the day, not carry trades. That was a one-day profit. So I want to talk a little bit about carry trade versus per trade wins, and a little bit about expectation of success, and swinging for the fence, to kind of see if I could pull all that stuff together to give you a better idea of how these pieces fit together, right? I got to get a coffee though first. I just got back in from walking the bow dog. We went to one place. It was all overgrown. It was wet. I said, I don't want to do that. We go to another place, and the road had been totally washed out. We've had a couple of strong rain periods over the last several days, and it was amazing. The trench was probably about this deep, wide, and probably about that deep, just gouged right out of the dirt road. Gouging the currency market with swinging for the fence. If you develop a consistency in your trading, which is what you have to do before you can swing for the fence, and if that's all you were able to do is make 0.5% on your bank, so that'd be $5 a thousand, $50 for a full lot. You make $50 on that full lot. You just trade that full lot every day and make $50. That's 100% return in a year. 200 trading days times 0.5%. Okay, so you look at what's possible in the currency markets that I didn't have when I was in, for example, the real estate, as a real estate investor for 40 years. Yeah, I made a lot of money, but it took me 40 years to do that. And I lost $1 million twice during that period of time due to economic collapse. And you just can't get out of the real estate. You can't just go, oh, things are going south, I'm going to sell my real estate for top dollar and then I'll get back in when it turns around. You can't do that. You just got to hold it. Most people panic and they sell and they go broke. I held it. I lost $1 million net worth, which was all the net worth that I had at the time. I made it back each time, but it took me 10 years each time. And so when we're looking at the currency market and we say, oh, okay, let's just say that you know what you're doing, you've got a good win-to-loss ratio, you're ticking all the boxes for the metrics that you need to have in order to be a successful trader. And you've done that over a long enough period of time where you've run into most of the market conditions that you're going to run into. And so you're familiar with when you can trade an on-farm payroll, for example, and when you probably ought to sit on the sidelines. Or if you are trading it, when it starts to look a little dicey and you get out. In other words, you're a trader. You're not just thinking about it. So now the decision comes up, how do I take my conservative lot sizing? For me, it's a $10,000 a lot. So if I'm going to trade 10 lots, I got to have $100,000 behind me. Would I need that? No, I could probably get by on $7,000 a lot, which is $30,000 less than what I'm trading with, but I'm doing it for risk management purposes and I'll explain that in a second. Well, I better explain it now because I'll forget. Well, if I trade with that sort of 10 to 1 leverage, and the trade is going for me, and I get out to some point where when I bring my stop up, then the number of lots that I already have in there will average out to a decent day's pay. Maybe that's 0.5%, maybe it's 1.5%. I mean, you got to squeeze the lemon for all of the juice you can get out of it, right? But again, if all you could do is 0.5% a day, you're going to double your money. So, in looking at that scenario, when I get to the point where I could guarantee myself that, I carefully walk the stop up, let that price get a little bit higher, and then boom, I load up the truck. And not only do I load up the truck with the number of lots that I have available to me at 10 to 1, $10,000 a lot, but I'll go down to maybe $6,500 a lot and add more lots because I've already made profit on the position that I've already got. So I might have started with maybe 5 or 6 or 7 lots, something like that, and I've established my position. You have to understand the difference between establishing your position and then working that position, as opposed to just constantly farting around and not knowing where in the life cycle of the currency position that you're at. Regardless of that, once you have figured out how many lots of the available lots that you have that you need to trade in order to get to 5 pips or 8 pips lock profit, and that gives you that 0.5% return on that amount of money, then now you can change the way that you think about swinging for the fence. You don't swing for the fence before that. And that's how I got caught in that 7-day carry trade. I ended up making $4,400. But I was going for a short profit target, and I was trying to squeeze that for a little bit more than my average daily run. And so I was loading up with more lots than I normally would in the beginning because it was going to be the last trade of the day, and I thought I'll just put a large, very large position on in the beginning as I build with lots. Let that run eight lots, 10. Let that just run 8 or 10 pips, which should have been a very easy thing for it to do, and then I'll get out and I'll make, I don't know, I think that it was $1,300 I was going to make. But it didn't work out that way because I went in with my initial build. It went against me a little bit, and then it came back and went down. I think I've explained this in one of the other videos. I added a little bit more lots to it. In any event, I got relatively heavy at the top end, heavier than I should have been, and then it went like that, just like a rocket ship. It took off and went against me, and I was, I don't know, $3,000-4,000 behind, $5,000 behind. I mean, from a percentage standpoint, it wasn't that bad. From a dollar standpoint, it's a ball breaker. So I said, I'm just going to have to let this thing run because I just have a lot of confidence in my analysis of the trade. Again, a video that I just did is that I have that, I'm experienced enough where I can say what should happen. I just don't know when it's going to happen. But all the forces were lined up and said, well, that should happen soon. Well, in this particular instance, it took 7 days for the soon to come around. We go down to that 7th day after holding that, and it's gone between, I don't know, $1,000 up to $4,000-6,000 behind. So there's all this variance. There's a lot of volatility in the market. And that's when you want to swing for the fence, when you've got that volatility. You just have to get the when component right, because if you don't, the volatility will take you right out of the game, particularly if you front load the position, which is what happened to me. So I made one major mistake is that I thought I knew where that position was going to go. Ultimately, it did go there. I made $4,400 on the trade, but I didn't know that at the time. What I should have done is, when it first started to go against me a little bit, I should have taken the clip for a couple of $1,000, and I would have been all set. I've had, I think I've traded 14 times this month, and I've had 3 losing trades. One of them was $254. The other 2 trades were for $2,600. So I could have added that on. I mean, I'm up. Well, I'm up 18,000 bucks so far this month. Well, I'm talking about August. I'm in September right now, and so I closed. I'll probably close out about 18 or 15, between 15 and $18,000. So taking when that trade went against me, taking that couple of $1,000 loss would have probably been the thing to do. But remember, in a lot of the videos that I've been doing, I'm saying, well, don't let it run out to the point where that dollar value gets too high, because then you won't want to close it out, because it's a lot of dollars. I mean, if you guys are down there trading minis or a couple of fulls or something like that, then those values aren't significant for you. You know, you get a lot of guys that are saying, well, you know, let your stop be out at 20 pips. Well, that's great if you're trading a 2 lot. I mean, that's $400. That's great. Try trading a 20 lot at that. Okay? So we need to be realistic about how the dollar value impacts us, even though intellectually and mathematically and statistically, if you just cut that thing short at 3 to 5 pips. I mean, look, when you enter the trade, it should go in your favor, or you shouldn't enter the trade. And even though right when you enter that trade, it's 50-50 jump ball as to whether you're up or down, subsequent 2 or 3 bars should put you into profit. So you got a 1 ATR that goes against you on a short-term trend, like a five period chart, time frame chart, and you've got a ATR of about 5. So, you know, you take a 5 pip or a 6 pip pause in the price, because that's that 50-50, that normal 50-50, it's working against you. So you got to figure that that's going to go anywhere from 3 to 6 pips anyway. So that's why I've got my stops generally run about 8 to 10 pips when I follow my rules, because I want to get out, because that 8 pips could soon become 80, and what I could have done is I would have out, and I would have seen this movement of volatility the other direction. I could have hopped on board, made $150, $300 or something like that on that slide. And when I get nervous, I get out, the thing swings back, because you have a pretty good idea of where that price should go. It's going the opposite direction, so that means, guess what? It's going to go back where it was. And so that was my confidence with this trade that I'm talking about, that it would ultimately come back. So I did a hold, but it didn't come back, and it stayed negative, and it hovered constantly around that $4,000 or $5,000 holding period. And I thought, oh man, that just really sucks. And so, you know, you hang on to the thing, and boy, you just look at it and you go, where in my thinking did I go wrong? I mean, it's a learning process for you to look at that loss and see what it's doing, and saying, gee, why didn't I see that? Well, the answer to that is you can't see that, and that's why you have to short stop yourself out, or you get jammed up like I did. Regardless, when the price did start to turn around and it went $400 or $500 in profit, I did a re-entry evaluation of that position, and I said, because it went negative away from me so far and held that so long, but it couldn't retain that, and now it's going in the opposite direction. My experience said it's going to really rip it, and it's going to really do a tear-ass. So my original profit target was $1,300. I said, I think that's not aggressive enough, and so I'm going to go and move that profit target out to reflect the conditions of the current price action. Current price action, when I put the trade on, wasn't there for any more than that $1,300 gain, and that was being really conservative. I got it wrong, and off it goes. So now you reevaluate the situation, and you say, wow, this is going to go. So I extended where my profit target was, and then when it was a couple of $1,000s in profit, I dumped a few more lots on there. It dropped, boom, I'm out. I made $4,400. But I had that. It took me 7 days to do that. So now I'm trading along the next day, and I'm looking at the situation of what's happening, and I go, wow, that after, by the way, after my profit target was hit on that $4,400 gain, I closed the trading platform. I said, I'm out. I don't want to trade anymore today because I've loaded up. I'm okay. That thing turned around and went 60 pips in the opposite direction. I mean, I would have been $12,000 under if I would have stayed with that. So I don't know what I would have been under, but it had been a lot of money. So I'm looking at the price action the next day, and I'm seeing that although price had come back away from that, it had now come back down, and it was chattering. It was holding there, and it was like, well, this thing is just going to explode. This time I'll go in a little bit lighter, and so I opened the trade, I think, with 5 lots. That's light for the bank that I have. It clicked the 5. I went for 3 more. I'm carrying 8, and then I went in and I ended up with I think 14 lots, and the thing just kept going and going. Boom! I shut it down, and actually, what happened was it went within 1 pip of closing me out at. And again, my profit target was like about, I think it was like 2,500 or 2,600, and it didn't take it out by 1 pip. It went back up to the place where it would have been chattering because I was short, and it started to chatter in there. And I said, well, this thing is going to go down, but it's going to break that level. It's going to go down here. So I moved the stop on that one, and boom! It just went. I mean, I don't know how to explain it to you, but it just went boom. And I was out. So that whole trade that day, that took me about an hour and a half because there was that pause. When I saw the price right on top, I mean, I was right on it, I was looking at it on a 1 minute time frame, and the thing was just dropping like a stone, and then it just kind of stopped, and I thought, well, it's only got a couple of 3 more pips to go. How tough would that be? So I'm watching the thing, and all of a sudden, up it goes 5 pips away from the target. What I should have done is I should have just taken the profit. There would have been a $2,900 gain, I guess, and I could have lived with that. Geez, in 1 day. But I decided to hold it. It went back up against me, and then it started to come down, and I had moved. And then like I said, I moved the profit target again. I got the $4,100. So you'll notice in the first example, I loaded up too heavy in the opening, and so when it did start to go in my favor, I didn't have any dry powder left to add, and if I did, I was so heavily top loaded that my average position value, I mean, I would have had to. It just wasn't the right conditions, the right situation. So I just let it run. I picked up another couple of lots, I think, on the drop. On the second trade that I talked about, I made almost as much money, $4,100, but I did that in 1 day. I did it in about an hour and a half. So that's maximizing it, and that was swinging for the fence. Because I saw that thing coming down out of the past structure, I guess you'd call it, and did a reevaluation very quickly because the price was really moving. I went in 5, I went in right away, 3 more at about 5 pips, and then boom, 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 went butt load in, and I think I was 14 or 15 lots in, and the thing just went, psh, and boom, that was it, gone, $4,100. You have to do that, and you have to know how to do it, and more importantly than that, you have to know when to do it. And on top of that, if you're going to swing for the fence, you have to look at a longer time horizon for your risk. That isn't time horizon in days, it's time horizon in risk. If you're expecting, if you're on the shorter term time frames as a day trader, and you look at that 5-minute chart with a 5-period ATR, how far does it go up before it has a retraction, or how far does it move before it has a retraction? You know, it'll go up maybe 15 pips, and then it'll have a 5 or 10 pip retraction. So could that 5 or 10 pip retraction be a 50 pip retraction? Well, you don't know. But if you're looking as that price is moving up to the point where you're going to add lots, and you're doing upside down pyramid when you do this, you better be damn sure that that momentum is going to carry that price further, because when you load heavier later in the trade than you have in the beginning, that's an upside down pyramid, and it'll bring your average price very close to the current price. So if you don't get that son of a bitch out so that you can at least bring the stop up and get 2 or 3 pips on that load, man, that price will drop down below your average value, and now you're sitting there with 10, 12, 15 lots negative at $150, $140 a pip. And you're going to go, it should come back. But if it doesn't come back, $150 a pip times how many pips before the shit just comes right out your anus? How long is that going to take? So be very, very careful about when you think you're going to swing for the fence. You should have a plan that teaches you how to swing for the fence. But you need an underlying structure to that I've just tried to outline for you, in order to have a foundation of not only experience but confidence that you're willing to take a larger hit in order to let that price have room to move around well enough to build up the order flow that will then propel it with a lot of volatility to that whatever that profit target is. And you can't be a pig about the profit target like I was with that one, and it missed it by 1 pip. I had a previous profit target that was 4 pips above that. So for 4 pips, actually it ended up being for 3 less pips, the thing run $4,000 against me before it finally turned around and came back, and then I took out a $4,100 profit. So be careful about how you do this stuff. And if you have any questions, send me an email. Be happy to chat with you. Peter Rose, Longwood Currency Trading. Have a great day. Have a great trading day.